Okay, in this lesson we're going to discuss range trading the forex market in a non-trending market, and the strategy we're going to show you works fine for 28 currency pairs. This is lesson 4 in our 35 lessons package from forexearlywarning.com. So what is a ranging pair? Well, the forex market can be trending or ranging. A ranging pair is one that cycles up and down between support and resistance on one of the major time frames. So remember, a ranging market can go on for several days or several weeks, so you want to learn how to trade a ranging market so you can have a technique for making pips when the market is not trending. So in this example, in this basic example here, this is like a sketch of some exponential moving averages, which if you click on this link right here, you'll come to this page. It'll show you how to set up these trend indicators that are basically just moving averages for 28 pairs and 9 time frames. So what you have is you have some basic moving averages, exponential moving averages, attached to a price chart, and this is what a ranging pair looks like. It cycles up and down between support and resistance, and you want to look for oscillations or ranges on the major time frames, H4 time frame and larger. Now in some cases you'll have smaller time frames. Let's say the M30 time frame is cycling up, and it's actually ranging, but it's got increasing tops and bottoms. This pair is actually in an uptrend, so your entry points would be right around here when it reverses course back into the trend. Similar, sometimes the smaller time frames are cycling, oscillating, and ranging within the context of a downtrend, and you can have an entry point for a sell right here. But these are smaller time frames within the context of a larger time frame. Now, once again, range trading isn't always smooth cycles. It doesn't always look like this. Sometimes you have a choppy market, and it might be best to either do one of the following things. You can trade less lots or don't trade at all. So first thing you want to do when you see currency pairs that are ranging is check your time frame. You want to look for oscillating and ranging pairs on the H4, D1, and W1 time frames. Okay. Sometimes you can go to the H1 time frame if you have a volatile pair. We'll look at an example below. Then the next thing you want to do is you want to check the volatility and pip ranges. For example, if you have a currency pair that's ranging between support and resistance, you want to check, we call it the amplitude. It's the difference between the top and the bottom. You know, is this, how many pips are you dealing with here? Is this 50 pips, 100 pips? What is it? Well, if this is the H4 time frame and you have a less volatile pair, like so let's say the New Zealand US dollar, this might only be like 100 pips. Actually, this is pretty small. A lot of forex traders would love to find a trade like this with 100 pips of potential on the ranging and oscillating cycles, but actually that's pretty small. If you go to a pair, remember this is for 28 pairs. If this is the H4 time frame on a pair like the pound Swiss, this magnitude of pips, which I'll call it the amplitude, difference between the top and the bottom of the curve, might be 250 pips. And some you can get 300 to 400 pips easily on the D1 time frame. We'll show you an example below. So the next thing you want to do is, how do you enter the trade on a ranging pair? So your entry points would be, you know, when the moving averages cross on a sell, or if it hits support and starts to reverse again, as soon as the moving averages flip back, look like they're flipping back to the upside, you can enter a buy here, so you can buy the pair and then sell it, and buy it and sell it again. Because the market is ranging and you need a way to make pips when the market is not trending. So let's look at an example. Let's say, for example, this pair is the AussieCAD, the Aussie dollar against the Canadian dollar. Well, if you want to sell the AussieCAD right when the moving averages flip over, you can look to see if the Australian dollar is weak or if the Canadian dollar is strong. So you want to verify the entry on this sell. Well, you can go to our tool that's called the Forex Heat Map. You can click on the link right here and learn more about it. So clearly the Aussie dollar is weak on all 7 pairs we follow. So if the Aussie dollar is weak, then you can sell this pair here. Or you can also check the Canadian dollar pairs to see if the Canadian dollar is strong, because you're looking at the USDCAD. Then when it comes down to support and reverses back up and you get a potential buy point, you want to go right back to the Forex heat map, and you would be looking for the exact opposite of this. You would be looking for the Aussie dollar to be strong. All of these would be green. These two would be red because the Aussie dollar is on the right. So this is how you verify your trade entries into a ranging pair with the Forex heat map. Okay, and remember, this works for 28 pairs. The USDCAD is just our example pair, but you can translate this over to 28 currency pairs. All right. So let's look at some examples. This is the USD yen, and this is the H4 time frame. Okay. And these oscillation cycles starting here, this is 200 pips from top to bottom. Remember, we looked at this example here. Let's see how big the oscillation cycle is, the range is. And the range is 200 pips. So it's getting ready to, moving averages are getting ready to cross here. This thing is getting ready to possibly go up 200 pips. You can set a price alert here at resistance. When the alert hits, you can go look at the Forex heat map. Here's another ranging example. This pair is the pound yen, and it's ranging on the D1 time frame. Okay, so from the time this pair crossed here and you had an entry point, from the time it went up to here, this is 700 pips right here, because this is a volatile pair. So it's getting ready to cross again. So right now at this point in time, you need to start monitoring this pair with price alerts and the Forex heat map to look for British pound strength or yen weakness. And you're looking for an entry point. And from here to here is 500 pips. If it goes all the way back up to this resistance, it's 700 pips on one oscillation cycle. You can sell, buy, and just keep, because the pair is ranging. This is the USD Canadian dollar, and this is a 175 pip range on the H1 time frame. This is not a big time frame, but between here and here is 175 pips, and this pair is ranging. It's got increasing bottoms like the image we showed you up here. Increasing bottoms. Another fantastic opportunity all the way down to the H1 time frame. So range trading versus trend trading. What's better? Well, we don't really care. You can trade a trending market with these same moving averages and these same techniques for entry, setting price alerts, checking the Forex heat map. But when the market starts ranging, if you're a trend trader and you see that the market is ranging by drilling down the charts with multiple time frame analysis, and you see that the market is ranging, go ahead and learn to train. Go ahead and learn how to range trade the market. That way you'll have a method of collecting pips when the market is not trending. And remember that this techniques we're showing you works for 28 pairs. It'll give you a chance to make more pips when the market is not trending. So this is our lesson on range trading for 28 pairs, and this is part of our 35 Forex lesson package at forexearlywarning.com.